Welcome back, Alpha Hunters. Hope everybody is doing fantastic this week. The markets are closed for the week of March the 24th. So let's take a look at what went on this week. It was kind of a busy week, choppy week, and nothing that wasn't really too unexpected. And I got a couple things I want to show off as well, but let's just go ahead and start it off by getting a recap of what went on this week. So Monday, slightly bullish. We had a little small gap up, traded higher, little bit pullback in the middle part of the day, and then just kind of had a slow grind back higher into the close. Tuesday was really kind of more the baffling day, in my opinion, as the day right before we got to the FOMC Fed Chair Jerome Powell rate hike day on Wednesday, we gapped up on the market and traded higher pretty good. Now, I know financials have been beaten up pretty good, so I guess there was just some opportunities out there. People just took it as an opportunity to be bullish. Really just interesting. Bullishness on Tuesday, so we had a nice little gap up, a little bit of a pullback in the moving averages, and then pushed higher, kind of at the highs with a little bit of a pullback. We then got to Wednesday, and we didn't really do too much in the beginning part of the day. We just kind of hung out. We went a little bullish, went a little bit bearish. And then we got to the Jerome Powell interest rate decision. They raised interest rates 25 basis points. Most of the market was expecting that. But the thing to kind of understand here is that there was a lot of reduction of interest rate hike probabilities over the previous couple of weeks after we've seen some banking issues. The odds on a couple of weeks ago was a 50 basis point rate increase, but that wound up obviously not happening after the banking issues we've seen, and the market took it as a little bit of a bullish sign. Here on this lower wick right here, about 30 minutes after we got the rate hike decision, this is roughly when Jerome Powell had started talking at his press conference. And it was really kind of interesting because after he said, yeah, we felt like it was necessary to do 25 basis points, and we probably only have one more 25 basis point increase coming next meeting. And he said after that, we're going to be very data dependent. And he kind of walked back a lot of we're going to continue to push rates higher going forward, all that. He had been much more like, let's see what kind of issues the banking sector and the credit sectors kind of give us. Because if you're listening to the press conference, it didn't sound very upbeat and optimistic, and he knew the answers, and a lot of that. It was a lot of uncertainty, a lot of waffling on some of the credit questions, banking questions. So it was just one to really kind of shocked that the market even popped right here. But I think the market really let this pop here, mostly because he mentioned probably only one more rate hike coming. Now the part that there's only one more rate hike coming was because he mentioned the most likely outcome is the credit market is going to tighten. And he said the credit market is probably going to do more of the job for us than what we have to do in far as raising the Fed funds rate and that kind of stuff. So he said the credit market's probably going to help us. But my main takeaway here was they don't really know how bad it's going to be, and they didn't want to commit themselves to possibly locking themselves into raising rates or saying they're going to raise rates in the future. And it was just kind of more of a telltale that I don't think they really know how bad is it going to get. I think they have an idea that it can get much worse, as they've probably been asking a lot of the other major banks and regional banks what's their situation around some of these risks. And it probably hasn't been a good answer. So I would imagine they don't really know how big the impact could be. Basically, after we got the little pop, after Jerome Powell mentioned 25 basis point increase one more time, or roughly one more rate increase going forward, probably the one in May, the market just kind of sold off. The market just sold off all the way into the close. Very sharp drop really in that last 15 minutes, even 30 minutes of trading, just a very sharp drop. If you want to see how much of a drop that really was, I mean, that was roughly 1 3/4 in the matter of 30 minutes. So market can move when it wants to move. Thursday, we come out, gapped up, really kind of surprised by this. Gapped up, traded higher for about an hour and a half, and then just steadily rolled back over. Took out Wednesday's low here and just kind of chopped around very violently, really in that last hour and a half or so. So yeah, it was a pretty choppy day right there at the end. Friday, a little bit of a gap down, as we started to hear some more issues. And really Thursday, started to hear some issues about other banks, especially Deutsche Bank. And if you want to check out Deutsche Bank and their ticker symbol, go check out DB, and you will kind of see what we're talking about. Had some issues with their credit default swaps going really, really high, and their stock price started taking a hit. So we had a little bit of a gap down then on Friday, hung out for a little bit, and then very slowly grinded higher the rest of the day. This is not exactly like a bounce, and we can talk about sector rotation here in just a second, but I wouldn't really say this is like a strong bounce. I would say this is more of just consolidation and probably just rotation. Okay, probably just rotation. All right, let's take a look at how sector rotation played out for the week. So basically started on Monday. This is kind of what went on. XLC, XLK, XLE, the top three performers for the week. Pretty good flow, especially in the energies. They got beat up last week or the week before, so energies kind of came back and did pretty good this week, especially earlier in the week. You see the purple line up top here. The bottom three, financials, not shocked there, right? Real estate, probably not shocked there, with a lot of, they're very closely tied to financials. Utilities, all right, so utilities got hit pretty good early on in the week, and you kind of see, this gold-ish kind of line kind of really dropping off, especially on Tuesday and Thursday. Pretty good. But let's take a look at something else. Okay, so we are taking a look here at sector rotation for Friday. Now this is very important to understand because we saw a lot of outperformance in the safe haven names. We did not really see that outperformance coming from the risk on type names. And you can see real estate performed very well on Friday, getting that bounce back. Utilities, safe haven, man, people were flocking to it. They were up very strong. Materials did pretty well also on Friday. Energies did pretty good on Friday. Here's healthcare also doing pretty good. Industrials and staples. A lot of those names that had been beaten up were getting bought up. Okay, so a lot of opportunities out there in a lot of areas, non-financials. I'm not even going to mention like opportunities of financials just because I think they're toxic as heck right now. But there was a lot of great opportunities in sectors and stocks that have been absolutely gotten beaten up over the past couple of weeks just due to the whole financial and banking areas. But the three that did not do well: tech, discretionaries, and communications. So are we going to continue to see this rotation kind of going forward? Yeah, probably. And there's a couple other charts I'm going to show you why. Okay, take a look here at the VIX. VIX came down from the open of the week. The implied volatility, obviously on Fed week, like uptick in implied volatility to start off the week. Dropped pretty good Monday, Tuesday, and just kind of hang out very violently this week. Very violent kind of hangout week, but it looks like it's more of just consolidating. We'll see if it's a push up or push down later on. The dollar was not strong for most of this week. It was just having a hard time finding its footing. Nice little almost morning star reversal pattern kind of setting up here between Wednesday, Thursday, and Friday. Lower wicks. It's under the moving averages. It's going to be tough. It's probably just going to chop around before it continues, whichever way it continues. Take a look at the 10-year yield. 10-year yield definitely coming down. It just hasn't been good for the yields. And taking a look here at the 10-2-year inversion, very solid pop above the consolidation that's been put in over the past couple of weeks on Friday. Yeah, I'd imagine it probably just hangs out at these upper levels and then eventually pushes higher later on. I don't think we get back down to the levels that we put in earlier in March, or back on March 9th and 8th. I don't think we get back down to there. I think we have started our path back to the normal area. Kind of mentioned it last week. GLD seems to be a little bit ahead of itself. It was a choppy week, kind of a pullback. Popped higher Wednesday, Thursday, and then Friday came back down. I just expected a little bit more of a chop and probably just a pullback later on. But I would just still be waiting a little bit here on gold and GLD to set up a little bit better. As it seems like it already made a strong move, and you don't want to be buying here and it comes back down for another pullback. So I would just wait, see what kind of sets up. HYG, very solid bounce earlier part of the week, and then kind of pulled back pretty good here to end out the week. So we'll see what happens here, but very, very sharp bounce on Wednesday with a very quick pullback. I don't really kind of know what to think about bonds right now. Bonds are just being really difficult. They're being pretty volatile, and there's been a lot of headlines and rumblings about the uptick in bond volatility. So we'll see if bond guys continue to hold out. The LQD side of things, it seems a little bit more of the safe haven, right? The investment grade stuff. People are just going to safe stuff. Okay, that was a theme on Friday with the stock market, but we're seeing this more continue through the bond market with the HYG, and you saw that. But the LQD was performing pretty good even in the second half of this week. Okay, so taking a look here at the week over week change for options contract expirations. And, we're still seeing quite a bit of put buying out here from last week to this week, especially out here in May. May 19th was getting hit pretty good on the put side. Also, still April 21st still continues to be hit pretty heavily. But one thing that's interesting is past August, as you get to September and later, you see more calls than puts on a lot of these expirations. I know there's not a lot of volume out here, but not a lot of people bearish out here in the latter part of the year. So it seems a lot more people are bearish probably here over the next 3-4 months, and then after that it seems like it kind of settles out. Even the a lot of the put buying in the summertime isn't really as high as it is here over the next 3 months or so. But as you get into July and later, the puts buying kind of dies off, and even the call buying even picks up over the put buying in a lot of those months. So I just wanted to show off the April 21st expiration and just kind of get a general idea of what a lot of the different expirations are out there. And what you kind of notice is there's a lot of spikes out here just all across, all the way from like 400 all the way down to about 360 on the put side. And that's the red line is all the puts, right? All the open interest at those strikes. So there's a lot of spikes out here, but once you get past 355, you kind of notice there is just a lot of volume, I mean, it's just consistently over 50,000 contracts at like every expiration. I mean, there's a lot of contracts out there the lower you go. So I don't know if we break down that much before then. I really don't think so. I'd be surprised if we break down and hold below 370 by April 21st. But yeah, there's a lot of put buying going on out there, and I wouldn't expect catastrophes here over the next 4 weeks, but the market's going to do what the market's going to do. Okay, so there is a couple of articles I got here. They're from one's from Reuters, the other one is from Fortune, and they kind of give you a pretty good understanding of what is to be expected. Okay, so JP Morgan, Citi, and Bank of America tell their staff not to poach clients from stressed banks. Okay, now why would you do that? Why would you tell, hey, do not bring in business? A big reason why is the second article I got here. Okay, the second article is U.S. banks are sitting on $1.7 trillion of unrealized losses, research says. That's not a problem until it is. Okay, so if you remember in last week's video, feel free to go back and watch it if you want to get a little quick recap of kind of what happened with the Silicon Valley Bank and why they had to run so rapidly. The big issue here is this $1.7 trillion in unrealized losses. Now, this unrealized losses, the reason why you don't see it on anybody's balance sheet is because it's sitting in a long-term asset category, okay? Now, that long-term asset category is called held to maturity. That asset category, you do not have to mark to market. Now, this $1.7 trillion is if they were to mark those assets to market. And what would get you to have to mark your long-term assets to, short-term mark-to-market price levels? Well, if your clients have to leave and you have to sell out and you have to liquidate. And this is why JP Morgan, Citi, and Bank of America, at least these three that we know of, have told their staff not to bring in outside clients. Now, if somebody walks into the bank and says, hey, I want to move my money to your bank, you're going to do it, right? You're just going to do it. You're not going to ask them, hey, what bank are you coming from? You're not going to do that. But they're basically saying, hey, do not go out and approach people and say, hey, that bank's toxic, you should come over here. Like that's basically what they're telling their staff not to do. Okay. So one of the huge issues, and this is going to be a massive issue, like if you're trying to buy the dip on the market, especially in financials, you are doing it wrong. You should not be doing that. And some of the reasons why is because if any financial company, okay, any finance stock, if they did not hedge their positions for interest rate risk, they cannot do it now. Okay, it's done. It's a done deal. It's over. The market has already moved. And if they are sitting on assets that are now devalued as much as up to 40%, then there's nothing they can do. Like the market's already moved. And so if clients leave, then that makes the run on the bank. And here's the thing is the Fed is obviously working along with the FDIC and the Treasury, and they're trying to make sure that the banks are kind of going to make it through this, right? Now, their role, the Fed, their role is to make sure depositors are fine. They're not there to make sure capitalism and banks can take unlimited risk. And a lot of people, for whatever reason, kind of, I think, have mistaken Janet Yellen's narrative that she's been speaking about here the past couple of weeks, that, hey, we're going to ensure depositors' money is safe. That is not to say we are going to bail out the banks. That is not what they are saying, okay? So be careful about buying financial stocks, finance companies, bank companies, because they're going to make sure your money is safe. They're going to make sure your money's safe, but they are not going to bail out the banks if they took money, they invested it, and they did not protect themselves from potential risk. Okay, they are not going to do that. It's basically going to be the same case as like SVB in most cases of what I've seen, where they're going to make sure most of your money is safe. It's going to be a situation where if people start to sell out and go find investments in other areas, which, to be pretty honest, if you've had money sitting in a savings or banking account, you're going to probably go find bonds or yields or CDs or something that's going to give you 4 to 6% of a yield over the next 5 to maybe 10 years. I don't know, somewhere in that time frame, because it's easy to go get that. Right now, it's so easy to go get that. And that's like, if you don't need that capital that's just sitting in a bank, then you're going to go look for it. And I think this is going to continue just to be an issue. This is not solved. This is going to take so much time to fix this. And if people just start pulling their money out of banks, which I would imagine they probably do, as you can go buy bonds and get good yields, it's just going to continue to happen. Yeah, I mean, that's basically all you need to know, is if banks did not hedge their interest rate risk, they're probably just going to be on the hook for major losses. Anyways, that's the deal with this 1.7 trillion in unrealized losses. If banks got to liquidate their long-term assets, that's where the 1.7 trillion of unrealized losses comes from. Okay, and don't think it's going to be over really anytime soon. So it's always fun to kind of look at different charts and stuff that's out there. And one of the charts I'm looking at here is the Qs divided by the IWM. And one of the ways to kind of read and understand this chart is basically, if the asset is going up, the Qs are outperforming the IWM. Now, one of the things that we've seen here over the past couple of weeks is, well, how much the IWM has just gotten absolutely slaughtered from all the regional bank issues and a lot of these small cap issues with different stocks and stuff, whatever, all that kind of stuff. Okay, we all know about it. It's been going on for a couple of weeks now. But we've also seen an uptick in Qs and major tech company buying, like major big dog tech buying. Here's the problem, is we recently just took out the highs of this ratio back that we had back in like late December, early January of or February of 2022. So I would just say right now is probably not the best time to be buying tech. Right now is going to be the best time just to go find some opportunities out there that are in other areas that have gotten hit over the past couple of weeks that are not in financial. I would not go buy financials right now. Absolutely not. I would go look at like industrials looking pretty good. They'll get hit if we have an economic downturn, but quality names, cat, deer, stuff like that. Go look for staples. Staples got hit pretty good over the past couple weeks. Utilities have gotten hammered over the past couple of months. So is healthcare. Healthcare names have gotten hit. There are a lot of great names out there, a lot of great sectors out there to be dip buying into. And right now, I mean, just looking at this monthly chart, look at this monthly chart. I mean, it's just crazy. Even if the thing just goes sideways here for a couple of months, kind of like how it did back on this hugely bullish breakout back in March of 2020. Obviously, we all know what happened there. It just went sideways. Like there's no opportunities, honestly, right now in tech. There's just not. It's just not a great opportunity spot. There are opportunities, just so many better areas. And if you really want to understand kind of the market right now is, we've seen the market get kind of sell happy here lately. And, tech hasn't been a part of that selling. So if people come out and start to sell off tech and try to go buy some discounted names, like the market could get to selling pretty quick because we've seen like 90% of the market get hit over the past couple of weeks, and we haven't really seen tech be a part of that. And tech's been the one kind of holding the market up. And if you want to understand what I'm talking about, take a look here at the SPY. And it made a nice little run here over the past couple of weeks. It's really kind of interesting that the SPY has S&P 500 has made this kind of a run. Well, if we look at the RSP, which is the equal weighted S&P 500, right? And the SPY is supposed to be a mimic of the S&P 500. I mean, it does not look anything like the SPY. And the big reason why has every bit to do with the Qs. The Qs in big tech. Big tech is the one over the past couple of weeks that really kind of held it up. And what kind of lagged behind today was the Qs. So if the Qs really start to sell off here and they kind of maybe even form like a double top pattern here, because we kind of have what could potentially, I guess, be a double top pattern. Not to say that it will be. I mean, it could be a double top pattern. I don't know. I mean, it's so hard to say. Like right here is a great time to be buying tech. There's a lot of other great opportunity out there. I wouldn't really say tech is it. They've been extremely strong. I'm not saying go out there and be bearish on them. They've been extremely strong. Don't go be bearish on them. If you do it, definitely understand your risk. As far as for now, I mean, I expect the market to be choppy. Don't expect a whole lot. And I got one more thing to show you. All right, so this is looking at the SP 500 index, 3-month chart. This is a 3-month chart. So basically, I just want to show you every quarter, right? Every quarter that we've had. And since the beginning of this bear market, we had 3 bearish quarters. And then Q4 of last year, we had a bullish quarter. We actually had a green quarter. Here's what's interesting. Right now, we have 1 week left in this quarter. Next Friday, we'll close out the quarter. What is interesting is currently right now, we have a green quarter. Okay, we are above the open. If we look back at 2007 to 2009, we did not have 1 green quarter at all in that bear market. Okay, if we look back at 2000 to 2002 in that bear market, we had 1 green quarter, then we had a bear quarter, then we had a green quarter, and then we bottomed. That's when we go on a run. But we never had back-to-back green or bullish quarters. Interesting. That's all I'm saying. Just interesting. If we go back and look at the 60s and 70s, and we had like 3 bear markets back-to-back to back. So we had a bear market, 3 quarters, it was done. Here's another bear market. It was about 6 quarters, and it was done, not 1 green quarter. We had another bear market here, and this is a pretty sharp drop off here at the end of this one. But we had 1 green quarter, not another. We did not have a back-to-back green quarter. We didn't even have 2 green quarters in that one. So just kind of an interesting note. Even in this one here in the early 80s, we had 1 green quarter as we kind of had a little bit of a pullback. Here's the crash, obviously in 87. Obviously, we didn't even last longer than a quarter in that drop. The only thing I can say is if you're going to play it next week, my bet is we close below the open of this SPX, which would be the open of the year, which is where we ended December, which for this chart here on the SPX would be 3853. 3853. And where does that equate to roughly on the SPY? Well, if you look over at the 30th of December, be about right here, about 382 or so, right there, which is basically the lower part of March the 13th. March the 13th. So I would be willing to bet that we see some selling come in next week. And even if on Monday and Tuesday we maybe just, chop sideways and maybe start to roll over, and then Wednesday, Thursday, and Friday we just kind of fall off here, that would be my bet. So that's kind of what I'm looking at. Those are the kind of things I'm looking for. I in no way think we are anywhere close to done with this bear market, and we'll see what happens here the next week, but it's still just going to be choppy. It's going to be super choppy. I don't think we're going to see chaos yet. Not until people give up, and people are obviously still buying the dip. People love their tech stocks. And once tech gets selling, that'd be the big one. That'll be when we really start selling off in the marketplace. But with how elevated the tech and Qs are right now, it's just not a smart place to put your money. It's just not. I mean, I'd rather put it under a mattress, honestly. Anyways, that's about all I got. Have a great weekend, everybody. Talk to y'all next week. Alrighty, take care, Alpha Hunters.